What's going on, guys, and welcome back to another very exciting video. We are going to be talking about a stock that I personally do not own, but I've been interested in for a while and looking for the right time to get into, and that is Amazon. And Amazon just announced their earnings on Thursday after hours, and we saw the stock make some very interesting moves. So what we're going to talk about in this video is why the stock made this very sharp upward move and then very sharp downward move, and what that means for the company going forward. So if you enjoyed the video, make sure you drop a like down below, and if you want to see more videos like this one, make sure you hit that sub button. Let's start off by taking a look at this move that we have in the stock price. We can see that after hours, the stock jumped up over 7% at 1.85% up based off a very good revenue beat that we saw out of Amazon. However, guidance was given about their AWS segment, and from there, the stock fell over 11%. And these are two very large moves out of a company with a market cap that is over $1 trillion. And right off the bat, we saw some positive numbers out of Amazon. We saw their EPS come in at 31 cents per share, and we saw their revenue come in at $127.4 billion, which was higher than the expected number of $124.5 billion. And a revenue number of $127.4 billion represents an increase of 9% year over year. And when we adjust for changes in currency rates, we actually get a growth rate of closer to 11% year over year. And even Amazon Web Services had a fairly decent growth rate of 16% year over year, coming in with a total revenue of $21.4 billion. And with Amazon's numbers continuing to grow, you would expect Amazon's stock price to jump up and stay trading high. However, Amazon's chief financial officer came out and had the following comments. As expected, customers continue to evaluate ways to optimize their cloud spending in response to these tough economic conditions in the first quarter. We are seeing these optimizations continue into the second quarter, with April revenue growth rates about 500 basis points lower than what we saw in Q1. Amazon Web Services has been a significant growth vector for the company, and with it slowing down, this has spooked off some investors as they have started to try and price in what a slower revenue growth for Amazon Web Services could be for the future. And here we have a chart of Amazon Web Services revenue over the last 10 years. We can see that 10 years ago in 2013, they brought in $3.1 billion, and just last year, they brought in over $80 billion for the company. In my opinion, this slowing of growth could actually be an overreaction and could present a good buying opportunity for Amazon. We can see that they also announced during their earnings report that they are partnering and continuing partnerships with Southwest Airlines, BBVA, S&P Global, Snowflake, Stripe, and T-Mobile. And all of these partnerships will help boost the revenue of this segment and continue growth into the future. And in my opinion, Amazon has two very large growth vectors that could come into play in Amazon Web Services and really help actually propel their growth into the future. And those two are Amazon Bedrock and Amazon Code Whisperer. Amazon Bedrock is a new managed service that offers customers the easiest way to build and scale enterprise-ready generative AI applications. So basically what it is doing is it is allowing customers to access AI technology and integrate it with their already existing business, as they have seen and done with Amazon Web Services. And Amazon Code Whisperer can similarly be integrated into businesses like Amazon Web Services, as it is an AI code companion that improves developer productivity by generating code suggestions in real time, with an overall aim to help improve the productivity of these coders and really help them generate code at a quicker pace for the companies that they work for. And in my opinion, these two services are what's going to get Amazon Web Services back to a 20+% growth rate. An additional positive thing that I saw on this earnings report was their free cash flow improved to an outflow of $3.3 billion for the trailing 12 months. That's compared to an outflow of $18.6 billion for the trailing 12 months ending in March 31 of 2022. And what this tells me is that Amazon is starting to get back to generating cash. They spent the last couple years really focusing on growing the business and spending capital to build out their warehouse infrastructure, and now they are starting to focus back on efficiency and growing their cash flow, their revenue, and their EPS. And we can see that free cash flow issue represented more here graphically. Over the last couple of years, they have had negative free cash flow as they've really focused on growing out their infrastructure and a lot of CapEx spending. One thing I personally look for in a company is that they are willing to buy back some of their own shares. And last quarter, Amazon did not repurchase any of its common stock. And that could be concerning for a number of reasons. The first being that maybe Amazon does not have enough cash flow to repurchase its own stock. The second reason could be that they believe Amazon right now is not trading at a proper discount discount. They believe that the stock could fall further. Or 3, maybe they believe that they have a more growth potential by spending that cash within the business instead of buying back their own shares. In my opinion, it's probably the first and the third option. I believe that they probably see a lot more growth by spending the cash within the business, and they probably don't have a whole lot of cash flow right now to spend anywhere else other than on a lot of their business needs. The only reason I personally don't own Amazon is because of their valuation. Right now, they're trading around a 61.73 forward PE ratio, and for me, that is a little bit rich for the company. I would love to see the company fall down to like a 30 to a 35 PE ratio. I think that's a lot more reasonable for where Amazon is trading, especially when you compare it to some of its peers like maybe a Microsoft. One thing that is interesting about the company is that their highest trailing 12-month EPS was around $3.24. So if you believe that over the next year they could get back to that mark, they would actually be trading at a 32.4 forward PE ratio, which seems a lot more reasonable in my opinion for a company like Amazon. Personally, I am not really ready to buy into the stock. I would love to see it fall to $100 to $95. Somewhere in that range I think would be more reasonable, and I'd feel more comfortable pulling the trigger on purchasing some shares. But right now it's really just a little bit out of that range. And I think this earnings report has made me a little bit more comfortable with Amazon. They've started to get back to free cash flow growth, and that's really what I want to see. I want to see them dial back on some of this capital expenditure that they've done over the last couple of years, and they've really started to show that. So maybe next quarter or over the next quarter, if the stock price falls to what I deem a reasonable price, then I might actually look to start building out a position in Amazon. But overall, again, do not buy a company just because some random guy on YouTube talked about it. Make sure you are doing your own due diligence and looking into these companies and making sure they fit your risk tolerance as well as your time horizon. So overall, if you enjoyed the video, make sure you drop a like down below. And if you want to see more videos like this one, make sure you hit that sub button. And as always, guys, have a wonderful rest of your day.